It's no secret childcare is more expensive than ever. And that's why so many employers today are trying to offer relief. So if you're choosing benefits at work, you might see an option for a dependent care flexible spending account, usually just called a DCFSA. This is your ticket to savings. What's it all about? Well, let's talk about it. As the name suggests, a dependent care FSA is a workplace benefit that lets you use tax-free money to pay for eligible, wait for it, dependent care expenses. It's a special fund just for family caregiving needs. And because the money is tax-free, you end up saving around 20% on whatever goes into the account. Of course, it depends on your personal tax rate and specific tax situation. But that's money that would have gone to the IRS. So you're essentially maximizing your purchasing power through tax savings on eligible expenses. And there are lots of DCFSA eligible expenses: child daycare, preschool, summer camp when kids are off school, before and after school care as well. And also, this isn't just for childcare. You can also pay for adult and elder daycare if a spouse or other person qualifies as a dependent in your household and needs additional caregiving. So, how does it work? Well, you elect an amount to put into the account. Then, each paycheck you'll see a DCFSA deduction to cover a portion of the amount you elected. Over the course of the plan year, you can spend the money in the account as needed. Note, however, that unlike a traditional healthcare FSA, you do not get the full benefit amount at the beginning of the plan year. Your balance accrues and is available to spend only as you make contributions. Now, there are 3 huge caveats with this benefit that we should talk about. First of all, this benefit only covers dependents living in your household who are listed as dependents for tax purposes. So if they're not claimed as a dependent on your tax returns, then they're not eligible. In addition, this benefit only applies to dependent children under the age of 13, and then also a spouse or other adult dependent who physically or mentally are not capable of self-care and require additional caregiving needs. Okay, so that's what counts as a dependent for this benefit. The next big caveat is that you can only use this benefit to pay for dependent care during working hours, or if your partner is unemployed but actively looking for work, or if your partner attends school full-time. So, sorry parents, you can't use this benefit to pay the babysitter for a date night out. But you can use it to pay the babysitter for after-school babysitting needs, again, if you're actively at work or your partner is searching for work. Finally, the third big caveat is that DCFSAs are use it or lose it accounts. In other words, DCFSA funds eventually will expire. If you don't spend your benefit, you lose it. Now, your employer may offer a grace period extension at the end of the plan year, giving you a little extra time to spend your benefit or submit receipts. But in all cases, unspent funds will expire at the end of the plan year, or at the end of the extension period if one is available. So that means it's super important to plan ahead. Okay, that's the big overview. Now, let's talk more about how to plan ahead to get the most from this great benefit. To start, you have to sign up for a DCFSA during your employer's designated enrollment period. If you choose to elect a DCFSA, you'll also have to decide at that time how much you want to contribute to the account for the plan year. There are a couple of important things to consider with this, so stick with me. Once you make your election, you can't change it without a qualifying life event. A qualifying life event is a major change in your life that allows you to make changes to your benefits outside of the regular enrollment period. Examples may include getting married, having a baby, maybe a spouse losing their health coverage, or even moving to a new area. In some cases, your employer may also permit changing your election amount if you change daycares. Qualifying life event rules vary by employer, however, so be sure to always review your plan details carefully. But the main point is that usually when you lock in your election amount, it's set for the whole plan year. And this is why planning is so important. Since you lose whatever you don't spend, you'll only want to contribute enough to cover expected eligible dependent care expenses. You don't want to over-contribute because that risks losing your money, which nobody wants. Now, let's say you have a lot of expected eligible dependent care expenses. Well, because DCFSAs are a tax-free benefit, the IRS limits how much you can put into the account. To see the latest DCFSA contribution limits, be sure to bookmark our enrollment center at healthequity.com/learn. Okay, so to quickly recap, as you consider how much to elect, keep in mind how much you plan to spend. Keep in mind contribution limits, and then keep in mind your specific plan details because remember what I said, Some employers may offer a grace period extension, which gives you extra time at the end of the plan year to spend down unused funds. So if your plan officially ends December 31st, your employer may let you still spend DCFSA money all the way through February the following year. This extension period varies, so be sure to double check your plan details. All right, now finally, let's talk for just a moment about spending your DCFSA. This is the best part, right? So there are two main options. First, you can choose to pay your provider directly from your online account, or you can choose to submit a receipt to reimburse eligible dependent care expenses that you paid out of pocket. In either case, you'll need a receipt from the caregiver. That includes their name, address, service dates, description of services, amount charged, and then also the provider's federal and state license numbers if applicable, as well as their tax ID or social security number. You'll also need to list the names of the dependent who received eligible care. Then, simply log into your online account, input the relevant details, upload a picture of your receipt, and you should be all set to go. It's super important to keep receipts because IRS rules are very strict about record keeping for this benefit. No receipt, no reimbursement. But beyond that, Health Equity makes it super easy to get great tax savings without breaking a sweat. Discover more about dependent care flexible spending accounts. Visit healthequity.com/learn.